Good evening, ladies and gentlemen. This is Conrad Bobilak, and welcome to tonight's webinar on Australian Real Estate Market Update 2019. And really what today is all about is to look at a little bit about what happened in the market in 2018, and also, more importantly, what's going to happen in 2019 and 2020. We're going to be looking at a number of factors during this webinar. And these factors are really the key drivers of the current property market in Australia. And I'm going to talk about a number of things ranging from the banking policies that are changing as a result of the pressure that APRA has instilled on the banking sector, right down to the uncertainty with the current government and potential transitioning from a Liberal to Labor government and potential changes to negative gearing and capital gain tax, etc. So tonight is really just purely about educating you about what are some of the things you need to be aware of in terms of what's happening in the market and how it's going to have an impact on different areas and what are the potential impacts on capital growth of the specific suburbs. At the end of today's webinar, I'm going to share with you my opinion about which areas in Melbourne are going to do well, which suburbs are going to experience double-digit growth this year, next year, and also which areas are going to underperform, because there are areas in Melbourne currently that are getting completely smashed, and there are areas at the moment that are booming and doing double-digit growth, and there is no slowing down at all. So it's very interesting how fragmented the Melbourne property market is now, with so many different areas doing very different things from each other. And that's because demographics are clustered in different areas and they tend to do the same thing. But also, it's the reality of the market. The market is very fragmented. Before we continue, I just want to make sure that you guys can hear me and you can see my screen. Otherwise, I don't have a conversation for the next hour or so to myself. So if you can just write, yes, we can see your screen and we can hear you, that'll be great. Fantastic. Bit of a personal disclaimer, my results aren't typical. I'm not going to insult your intelligence by even implying remotely that you can build a multi-million-dollar property portfolio like I have, or get any results whatsoever by listening to anything that I'm saying. At the end of the day, you've got to put in the hard work, do your own research, and make educated decisions yourself. For those who haven't heard me speak before or been to my live events, I'm a real estate agent, a mortgage broker, and I've got a bunch of other degrees which kind of have no relevance to property investing. But more importantly, I'm a successful property investor. I'm in the market right now, buying properties, refinancing. So I've got hands-on real experience, and just because I'm an agent just gives me a bit of an advantage in Melbourne with regards to accessing things like RP data and talking to other agents and other developers and brokers about what the market conditions are, which means to you that you can benefit from all this information that I'm accessing every single day. For those who haven't heard me before, by the way, you can also pick up my book called Australian Property Finance Made Simple in any good bookshop or Amazon or bookonfinance.com.au for $32.95. So let's talk about the market. What really happened in 2018, because I think it's important to go back in time a little bit to explore some of the reasons why this cycle came to an end. And it's interesting because every cycle has different triggering effects, which I'll cover today in today's webinar, that results that market in slowing down. And that part of the market is a little bit unique because every time you have different factors. Sometimes it's unemployment rates, sometimes interest rates are record high. This time we had very low interest rates and very good employment. However, we had credit scoring and credit policies tightened up by the banks, which resulted in a lot of restriction in lending and other factors that kicked in as well. So it's important to learn from your history in order to give you a bit of a glimpse into the future. And that's, I think, where the very good lessons can be learned. So let's go back in time a little bit. Let's go back to 2017. On January the 1st, the banking regulator APRA lifted its cap on interest-only loans for investors, with APRA Chairman Wayne Byres deeming the speed limit introduced in March 2017 was a success. So if a lot of you don't know, from January the 1st, 2019, there are no more lending restrictions on interest-only investment loans in Australia. However, the banks haven't really taken to that, because not only do they have pressure from APRA to reduce the volume of investment lending per month down from 30% down to 10%. There's also been a royal banking inquiry into the banking sector, showing how bad the culture has been internally, not only in the banking and financial services sector, but in the financial service sector at large, especially companies like AMP, the golden boy of the industry, have been now exposed as being some of the worst companies in Australia, charging deceased estates financial planning fees, and having a culture that's largely driven by selling people into products and driven by commissions and upsales, rather than actually adding value to people and looking after their best needs and interests. And this is really what the theme has been with the Banking Royal Inquiry. And because of that, the banks, the four major banks, which control 85% of all mortgages in Australia, haven't really come back to the party to a large degree, in terms of being aggressively marketing investment interest-only loans for property investors. They're taking the easy way out, sitting back and letting the investors come back to them, which is, I think, very smart, because you don't want to do any kind of creative finance in this kind of an environment where you're under the microscope. So you're going to see those figures change over time. The latest banking figures show that demand for investment loans plateaued in 2018, with the major banks' combined investment loan books totaling $471.4 billion as of November 30th, 2018, a little more than $471.1 billion a year earlier. Since the market peaked in 2017, Sydney home values have slid by 11.1%, while Melbourne values are down by 7.2%, peaking in November 2017. This is according to RP data CoreLogic. The current downturn in Sydney, by the way, has been the deepest of any downturn since the 1980s. This is from RP data. And you can see there in this table, the blue line, the dark blue line, represents investor loans. Have a look at 2004. I mean, at the peak of 2004, 30% increase was driven by investment loans, which is interest-only loans for people buying investment properties. And this was the big issue. There was too many people. When people say too many people, this is according to what the government is comfortable with, what the threshold is. According to them, there was too many people having too much exposure to investment properties. And that's when they started to instigate different policies to try to reduce the volume of investors who have come into the market. And they weren't really successful at that, because they don't know how to do it, number one. Number two, most government agencies are quite useless unless they put pressure on the actual companies that know what they're doing, which is the banks. And that once the banks had enough pressure placed on them in 2017, they switched the button, changed credit scoring algorithms, made it really hard to get loans from a disclosure perspective, and obviously the loans plummeted from 30% per month down to 10%, which is exactly what APRA wanted. And now APRA's really comfortable with the banks saying, hey guys, you've done a really good job. You've controlled and reduced the volume of investors that have come into the market. We're happy with you. You can go back on your merry way and keep lending as you were before, which they are about to do. So this really has cooled the whole market off completely, mainly because people couldn't get money to borrow enough for the investment properties they wanted to buy. You can see that housing finance approvals also have been reduced to a large extent. Have a look at 2017, which was the peak, and you can see that that's pretty much when the banks hit the button. And look at the dark blue line; it just cascaded down to below negative 15%. So that means that that really there was a reduction and a exodus of investors from the four major banks. Now, always remember there's 480 lenders in Australia, so you don't have to deal with the four major banks ongoingly. There's a lot of choice out there. I don't know why people keep going to the four major banks. I don't know why they keep controlling 85% of the property investment market, and the mortgage market, but it is. I think people feel just safe with them. Personally, I don't care where my money's coming from, as long as it's cheap. And it's structured correctly. There's no real advantage of dealing with a bank over other financial institutions. And you can see there in terms of this is where in 2017, so 2015 was the start of the major lenders announcing tighter lending criteria, and that had a big effect on things. And then they kind of did it, and then it recovered back in 2016 because the stock market was going nowhere, and really the money has to move somewhere. Interest rates are record low, so term deposits and every other investment were paying virtually nothing. The stock market was crapping itself, and the money had to go somewhere. Went into property. So once again, APRA cracked the sheets, and then there was further macro prudential tightening in 2017, and we know the results of that. And that really finished off the last property cycle, where properties have cooled off. People have cooled off buying properties in terms of the volume that's entering the market, and also, which is really good because the market is cyclical, and you need to take a breather. If you look at the last 10 years, this is from RP data. This is from December 2018, 10 years from the GFC. Outside of Melbourne and Sydney, there really hasn't got much growth. Melbourne has gone up by 73.5%. Sydney has gone up by 77.5%. Brisbane's gone up by 18.3% over the last 10 years. People speculate that Brisbane's going to boom now after Melbourne and Sydney. It's not going to boom, I can tell you. I can do another webinar on the reason why, but it's just going to go very slowly. It just hasn't got the money that Melbourne and Sydney has. It hasn't got those high-end jobs and heads of all those corporations that we have in Melbourne and Sydney, and we are kind of geographically landlocked in Melbourne and Sydney as well. Sydney's completely landlocked geographically. Melbourne, the best side of Melbourne is very restricted in terms of how much you can produce in terms of land, because there's no land left in the best part of Melbourne. So people are fighting over the same properties, pushing up prices, which is why we're getting really good growth in those particular areas. Now, you've got to understand something. This is the property market since 1960. And you can see there, we've had a lot of different things that are going to have occurred historically and will occur in the future. We've had recessions. We've had technical depressions nearly. We have recessions, by the way. Definition of a recession is 3 consecutive quarters of negative growth. We've had technical depressions, but we've got away with it because of exports or some other technical indicator turning that into our favor. But we've had years where there was no growth at all in Australia. And we've had declines in the property market, and we've had also declines because not only was the economy slow and there was the recession, high unemployment, high interest rates, there were other things like negative gearing introduced, quarantined in 1985, and then it was reintroduced in 87 because it didn't work and all the rents went up and people started shouting at the government, what have you done? Which is about to happen again, and so there's going to be a dip in the market as well. And you can see that there's been also stimulating packages like the First Home Buyers Grant introduced in 2000, which really created an upward trend into the property market. And in 2010, the First Home Owners Grant Boost was introduced in 2008. And then you can see there the macro prudential policies were initiated in 2015 or thereabouts, where things started to change. So the market is cyclical by nature. It goes up and down, and it's always going to do that. You've got to understand that this game is based on the market that is cyclical in nature, but it's growing and it keeps going up and up and up. And this is because we have a critical shortage of prime land in key areas, and we have record high migration into the country. The only thing that can really stop the market from growing is if we cut immigration, I should say, from other countries to a large extent. And if Labor's going to win the next election, I can tell you Labor's always pro-immigration. They want to open up the floodgates to Australia and let everyone in. I think we should be very selective about who we let into the country. If you can contribute to our economy, if you're a skilled person and you can speak English and you can just come in and get a job and pay taxes, you're more than welcome to come from any country around the world. If you don't know the language and you have no skills, you're going to be just sitting around on a dole, bleeding the country, then you can piss off to where you came from. That's my complete belief in Australia. And I'm a migrant myself. We immigrated from Poland in 1985, so I can say that quite openly. So it doesn't really make a difference which country you come from. As long as you can contribute to the economy and pay taxes and be a law-abiding citizen, you're welcome to come. But if not, if you're going to be a burden on the country, then you might as well just stay where you came from. And that's I think what we should be focusing on attracting into the country. We should be very selective of who we let in. So it's going to be interesting in terms of what will happen. But you can see that the market goes up and down. The market is purely based on population growth and scarcity of stock in prime areas. Where we are in December 2018 is and this is a simplified version of the previous graph depicting virtually this is dwelling changes in terms of percentage growth. So this really signifies the peaks of the capital growth part of the cycle. So when we have 15% growth, for example, in 2001, we had very high growth recently of 12 and 15%. And now we can see that December 2018, we're going into another decline. The thing about it is, really in the last 20 or 30 years, there's only been 4 major declines. Really 3 if you look at a 1987 stock market crash, and really they were followed by extremely high growth. So you got to understand one thing, is that the declines and the bottom of the market never lasts very long. And if you lose money at the bottom, well, you shouldn't be selling anything at the bottom. You should be buying and accumulating. But if you're forced to sell at the bottom of the market, sure, you can lose money. Let me tell you, people can lose money in everything they ever do, from whether it's stock market related, property market related, businesses. People are going to fail. Okay, it's a guaranteed thing. And that's fine. There's a percentage of people that shouldn't be doing anything. They're a danger to themselves. Whatever they touch, they'll lose money in. But if you're educated, if you know what's happening, and if you do your research and due diligence, then you're just minimizing your chances of making a mistake and then maximizing your chance of getting a good result. If you look at the decline at the moment in Sydney, for example, which is the black line, Sydney has really come off the strongest from its peak by going back. This is for last 12 months, 11.1% negative growth. And this is the black line is represented in 2017, 2018. But you got to understand why, because it's coming off from such a high median price of over $1 million now. So, $1 million down to 900,000 is pretty cool. It's no big issue there. So don't get too much carried away about things like how far the market falls. It's about how quickly it's going to come back up. So I see this thing as an opportunity. I always see these declines and these corrections in the market as an opportunity to buy the same asset with the same fundamentals, but at a discounted price of 10%. It's like going to a stock take sale. I hate shopping like most males out there. So I shop really. I have to shop though for clothing. My wife, on the other hand, my God, you can leave her out shopping all day. But what I do is I buy my 6 suits and my 10 shirts and usually 3 or 4 pairs of shoes once a year if I can avoid any other time. And I usually do it during the stock take sale. And I just spend 2 days in the city or Richmond or wherever, and I just buy the suits, get the shirts, get everything discounted, because you can get discounts, you can ask for bargains. The quality doesn't change. The fundamentals don't change. The shirt sizes don't change. The quality of the material doesn't change. You're getting the same suit at 30% discount, 50% discount, same shoes. The same thing with property. You got to understand, just because the property devalues by 10%, it doesn't mean that the fundamentals have changed on that property. It just means you're getting the same asset at a cheaper price. That's how you got to look at property investing. And you can see there, this is the historical period of peak through decline in Melbourne. So Melbourne now has lost 10% for the last 12 months, give or take. And these are the other times that Melbourne has declined. So from 2015 and 16, Melbourne lost negative 2.6%, and then 2010, 2012, 7.9%. So these are all the other times that Melbourne has devalued, and this is the same thing with Sydney. From 1984 to 1985, Sydney lost 4.9%, 89 to 91, Sydney lost 9.6%. But most of the time, the market keeps going up and recovers far beyond what it loses during the decline part of the cycle. This is the same thing with Melbourne. Melbourne's down 10%. Now, remember, Melbourne is 418 suburbs. Not every suburb, as I'm going to show you, is affected the same way. The median price is actually just the middle property sold in one period of time versus the middle property sold in another period of time. So it's not even a good indicator to gauge the market. It gauges the pulse of the market, the consumer sentiment, but it doesn't give you a true picture. Not every property in Melbourne, by the way, has gone negative 10%. There are areas like South Yarra, Box Hill, where properties are going up by 10%. So forget about, every suburb, every property devaluing by 10%. And there's different segments of the market, which I'll talk to you about as well. So to me, I just see this as a massive positive thing. And I just laugh at the media. The media always Armageddon, bloodbath, markets falling. And I love it. The fact that they say those things, by the way, I don't mind, because it's fueling the masses to think that that's the reality of what is happening. So I'm not against 60 Minutes going out and saying there's going to be a bloodbath on the streets. Yeah, bloodbath on the streets. Everything's going to devalue 40%. By the way, sell your houses so I can just buy them cheaper and then just make more money when the market recovers. So I'm not really precious about these things. I find it hilarious that it happens. And I find it hilarious that every year there's a whole generation of investors or wannabe investors that think this is all new, but I've seen this happen over and over and over. The thing about it is, you've got to take a long-term view with property investing. Have a look at the Melbourne and Sydney property price median appreciation since 1980. It was 50 grand for a house. Now, Melbourne now is 700, 800,000. Sydney is 900 to a million. And let me tell you something. In Melbourne, for 700 grand, what are you going to get? Nothing. A normal house in Melbourne, just a normal house, nothing to be proud of, just okay, is 1.5 million. Okay, a trophy home in Melbourne is $3 million. Okay, where you can just show off to your friends and family if that's what you're into. In Sydney, it's the same. $2 million, $1 million in Sydney is a one-bedroom apartment now. Forget about it. I mean, it's the worst suburbs where you've got $1 million price. In Sydney, a normal house, nothing special, just it's there, 2 million, 2.5. A trophy home in Sydney, $5 million. That's the reality. But guess what? They started off at 50 grand, 60 grand in 1980. And in 1980, people were saying, oh, the market's overinflated. It's overpriced. Who can afford these properties? They're never going to go up in value. The amount of people that were negative in the 80s saying the market's it's so difficult to get in. Your children will never be able to buy into the property market ever. I've got all the articles, all the stuff is there. House prices in Melbourne and Sydney have fallen, and you can see that that's the negative growth there, which we covered in the past. This is what I talked about before, bricks and slaughter. This is probably one of the best examples of lack of journalistic integrity that I've seen in the last 5 years. I mean, I don't watch TV anymore. I think 60 Minutes has really lost its credibility, and it's becoming irrelevant, really. And who watches TV anymore? I mean, the young generation doesn't watch TV at all. They watch Netflix and they watch things when they want to watch. That whole genre of sitting at home and watching things when they get released is over. These channels, these networks, just like print media, are becoming obsolete, and they're playing an end game. But anyway, it still is relevant. And it was funny because I was watching this and I was just laughing my head off. And I feel like Bill Murray in Groundhog Day when these things come out, because every time the property cycle dips and goes into a decline, these stories come out, and it's over and over. And they really pick the most disadvantaged people to showcase in these stories. They don't pick your investors with 10 properties who have a buffer in place, who are smart. They pick the worst people just to show you of what can go wrong, which is hilarious. And, it's going to happen again and again. I don't see this changing in the future. It's guaranteed to just keep occurring. Let's look at the report in a little bit of details. And I want to show you what happened with this, because I think it's relevant to cover this in this webinar, just because there's so much discussions about the property market crashing. And there'll be a lot of you out there who have never seen the property market go into a decline part of the cycle. So I just wanted to kind of prepare you, I guess, for some of the things you're going to be hearing in the media. Property expert slam 60-minute housing crash scaremongering. A television report alleging Australian home prices could crash by as much as 40% in the next year Next year's very important, guys, 12 months. So we're going to revisit this in 12 months' time, has been slammed by property experts. Titled Brick and Slaughter. I love that. The 60-minute report by journalist Tom Steinforth focused on the nightmare scenario outlined by digital finance analytics principal Martin North. It predicted 2/5 of your home worth would be wiped out in just 12 months, 40% in a year. And you can watch this whole story on YouTube. It's there, and it'll be interesting to see the relevance of this story when we tick over to 2020, whether they were right or they were wrong. And of course, they're going to be wrong. Many believe calling current housing conditions a downturn is foolishly optimistic. This is verbatim for what the journalist was saying. The slump we're in is more like falling off a cliff. Really? Steinford said, if numbers like that eventuate, there's only one certainty. Our entire economy faces catastrophe, the end of the Australian property boom time. That's true. The boom has ended. However, a new report from a leading property data firm, CoreLogic, and Moody's Analytics has poured cold water on these claims, forecasting more moderate declines in the nation's home values as the slowdown continues. Housing values in Australia's capital cities have fallen by 2.5% since the peak last year. This is the data that came out during the month or the day after this report came out, by the way, on TV. So this is from last year. Apartment values were down 1.7%, and the Australian housing market has been cooling since 2018, driven by most populated, previously mostly inflated market of Sydney and to a lesser extent Melbourne, Moody's said. We expect the national house values to fall by 1.6% in 2018, which they were wrong, because it fell by much more than that, following the 9.5% gain in 2017. Moody's said national house values were predicted to grow by 0.6% in 2019. The firm forecasted, and this is the actual forecast that was available to 60 Minutes during the time that they were doing the actual story, which is interesting because they came out with this data at the same time saying this is what we believe is the future of the housing market. So I'm showing you information that was actually taken last year during the time that this actual 60-minute story came out. So 2017, the market did 9.5% for houses, 5.5% for apartments. 2018, they thought it was going to do negative 1.6. It actually did a lot more than that. This is the national average, by the way, but for Melbourne and Sydney, they did obviously worse than that. And in 2019, it would be lower, and then a slight recovery in 2020. In Sydney, house values rose 12.8% in 2017 and forecast to fall 5.1% in 2018 before slow recovery in 2019. Moody's said apartment values are set to decline more slowly, down 0.2% in 2018, followed by a slow recovery in 2019. In Melbourne, house values are forecasted to decelerate sharply from 12.5% rise in 2017 to 0.3% in 2018 on the back of declines in inner Melbourne areas, which is very true. The apartment market is expected to slow in 2018, followed by a sharp downturn in 2019, which is very true. The apartment market was completely oversaturated in Melbourne, and there's going to be definitely, there was massive decline of values in apartment stock. Just have a look at these graphs for 1 second and reflect back on what is actually happening and what is going to happen. And we can see there, this is where property experts were slamming the 60-minute housing scaremongering story. You can see there, despite all the doom and gloom, the markets were just slowly going into a decline. You can see there in Sydney, it was going from a very strong market from 2012. And by the way, the Sydney market was flatlining between 2006 and 2012. The Sydney market was going sideways. Then it went up from 2012 to 2018, and then he went into a decline. It can't just keep going up forever. It's unsustainable for that to occur. And this is for houses, obviously. Apartments are a little bit different, but really they really tend to follow the market to a large extent as well. We can see there the dark blue lines in the apartment market was flatlining for the last kind of 10 years. And then it started to increase from 2012 up to a peak in 2018. House values across Brisbane are set to notch up a mild 1.5% gain in 2018, with strength in West Brisbane, Inner Brisbane offsetting declines in South Brisbane, Moody's said. The worst is likely to be over for the apartment market, which I don't agree with. Values are tipped to recover by 0.6% in 2018, followed by sharper growth of 6.2% in 2019. This is the interesting thing. Experts slam housing crash scaremongering. Property experts took to Twitter to rubbish the 60-minute story the moment it came out. So what I heard was that a lot of experts were called up by 60 Minutes saying, we're going to do a story on the property market. Can we have your input about what you believe was going to happen? And a lot of them said, well, nothing's happening and the market is slowing down, but it's not going to crash. It's going to do 5%, blah, blah, blah. The moment they were saying, and it's going to recover in a couple of years, the moment they were saying that, they stopped the interview and they basically said, right, we can't use that information. So it became apparent to them that 60 Minutes had an agenda. They didn't want to report the reality of what is happening. They wanted to create a story around this 40% bloodbath and have people, experts, substantiate and back that up. And obviously it was complete rubbish. And so when they couldn't get anyone to really substantiate and back that up, what they were trying to do then is take their statements out of context to still back up the story, which is exactly what they did. And this is why a lot of them went to Twitter the next day to distance themselves from the story. So SQM property research analyst Lewis Christopher said the next day, I do not believe the Australian housing market is going to crash. He wrote on Twitter, Sydney and Melbourne are significantly overvalued, but I take the view the overvaluation will likely unwind over a longer period of time. And this is this is a tweet the day after. I stated in my interview with 60 Minutes, the risk as well as the safety valves are still present in the market, e.g. strong local economies, strong population growth, banks are very unlikely to fail, etc. The program covered my comments on the risk and overvaluation only. So it was taken out of context just to suit their story. Mr. North also weighed on the debate, saying that the figures used in the program did not reflect his central scenario, and Channel 9 chose not to cover the more likely alternatives. So some of the experts were going, look, number of things can happen. Number one, it can do this. Number two, it can do this. Or number three, can do this. What they would say is to take the worst case scenario and make it look like that was their opinion. My best call would be property values fall in the region of 15 to 20% from the top over 2 to 3 years, but with some risk of a worse outcome, he said. I believe 2019 will be a critical testing year one way or another. So Michael Pascoe as well, as previously, as predictably bad as you knew, the 60-minute housing beat up would be, it was worse. Question, did they willfully ignore more balanced views? Were the pig ignorant of the subject or just didn't care as they chased this scary story for eyeballs? They didn't care. It was all about the ratings that are failing. This is another economist, Alex Joyner. I'm not too sure of the modelling that went into forecasting a 40% housing price decline in 12 months, as reported on 60 Minutes last night. But here's what valuation and affordability matrix looks like in the unlikely event it did happen. So there was a lot of these kind of feedback from different property experts. These guys actually know what is happening. Shane Oliver from AMP said another 40% Australian property crash call, 60 Minutes last night. There have been lots of these over the last decade. I expect more falls in Sydney and Melbourne over the next 2 years. But while crash is a risk, this note covered why it's unlikely, and there was a lot of reasons why it's not going to crash. So Melbourne and Sydney have outperformed everyone's expectations in the last 10 years, and I've shown this before, where to December 2018, last 10 years since the GFC, and by the way, if you've been following me for the last 10 years, during the GFC 2008, I was telling people this is the best time to buy real estate right now. And if you bought Port Melbourne, Albert Park, Elwood, all the areas that I was saying, Williamstown, Brunswick, Moonee Ponds, Essendon, all the key areas in Melbourne, Kew, Glen Waverley, Baldwin, Baldwin North, you would have doubled or tripled your money, and that's the reality of buying at the lowest possible market. This is what happened in 2006 in terms of the last property cycle. This is 2007. These are the areas that hit $1 million median house price. 2008, 2009. You can see it's all eastern suburbs in the Bayside. 2010, 2011, 2012, 2013, 2014, 15, 16, 17. And that's the $1 million. What do you think is going to happen next time around? It's going to be $2 million. Guess which areas are going to trigger the next property boom? Same areas that did it last time. East Melbourne, Toorak, Brighton, Canterbury, and it's just going to spill over from there. It's always about Toorak and Brighton, Hawthorn, or Canterbury or Camberwell. And it just goes on and on and on. And the other suburbs just follow on if they can. There is no spillover effects between some areas, but some areas do have a spillover effect. And then it's going to go to 4 million. It's just going to keep going. You've got to understand this is going to happen with or without you. It doesn't need your mortgage or your money for this to happen. It's just going to continue on. And if you want to know where Melbourne will end up, look at Sydney. Sydney is 10 years in front of Melbourne because of the extreme land restriction. I mean, there's suburbs in Sydney now where you need $15 million, $20 million to even buy anything. So this is the reality of the market. The market will play out again as it did last time, and it's going to be triggered in the same areas as it was triggered in last time. So very interesting. What's happening in Melbourne right now in 2019? Well, if you go back in time, and I keep talking about APRA really put a end to this property cycle. But if we go through a property clock, if we look at what actually happens as we go around the property clock, we're at 3 p.m. currently, which is an environment where there's interest rates rising. And we have sometimes we're around the clock at 3 p.m. We have very high aggressive increases. Then we've got very mild ones. You would have seen that the Reserve Bank of Australia hasn't increased rates. The bank swap rate is at record historically low levels, but the banks independently have increased interest-only loans interest rates to persuade investors not to go there, basically. And eventually what you have is you've got a critical moment where people are priced out of the market just because of a simple fact that wages have not gone up at all in Australia for the last 10 years, and capital growth has exceeded everyone's expectations. So eventually you have a lower volume of sales. People literally can't buy anything. And I'm not talking about everyone. Obviously, there's different segments of the population with different income bands. But majority of the working class in Melbourne have an average annual income of $78,000 per year. Now, 2 years ago, you could have borrowed maybe $500, $550. Now it's around $400,000, depending on your living expenses and your commitments. So obviously, as serviceability has been reduced, people's borrowing capacity has been reduced, and therefore there's been lower property sales volume. Construction therefore decreases eventually because developers stop producing stock because they can't sell it. Property prices fall at 6 p.m. is the lowest part of the property cycle, or 6 o'clock, I should say. And eventually you have rental yields increasing, catching up. It takes about nearly to 7 o'clock on the property clock, from the peak being 12 o'clock, for the rental yields to kick in. So this is where rental yields on townhouses and houses are around 5%, 5.5%. And eventually what you see, at 7 o'clock, you're going to see a lot of ads on TV, which will be rent money is dead money. Why make your landlord rich when you can own a beautiful Metricon home for $400 a week, just 120 kilometers from Melbourne? So you're going to see a lot of rent money, dead money ads at 7 o'clock, and people are going to go, yeah, why are we renting? We should just buy a house. Let's go 120k from the city, and then be stuck in traffic for 2 hours every day. And then you have an undersupply of rental properties. Then you have an interest rates reducing, rising property values, construction increasing because developers go back into the game and say, hey, there's money to be made in this game. And then you have the boom and the craziness at the peak. And, of course, then you have a decline. And, again, people saying Armageddon, bloodbath, everything's going to devalue by 60%. It just keeps going round and round and round. Rent will increase significantly in key suburbs in 2019-20. So if you're building a property portfolio right now, I want to give you some really useful information of what you need to understand about the market right now, where the money is. Because we'll be focusing a lot on just general information, but I want you to kind of walk away from this webinar with some real tangible stuff that you can implement. And where we are at the moment on the property clock is 3 o'clock. So we have a low, most of the areas have very low declining rental yields. And you can see there in Melbourne, for example, last quarter we've had an increase, and this is in house rents across Australia. Average house rents for $440 in Melbourne per week and $540 in Sydney. Although I don't know what you can rent for $440 in Melbourne. I mean, it's all of Melbourne obviously put together, because in the eastern suburbs and Bay side you need $600 for anything decent, and really you need $800 to $1,000. But anyway, rents have gone up by 3.5% in the last 12 months in Melbourne, and in Sydney they've gone backwards. So Melbourne is actually a better market to invest in right now to get cash flow. Better rents, 3.5%. When you hold a property over 10 years, you'll tend to find that your rental yield in Melbourne is around 4.5% to 5%. It's actually quite high. So this is an average over 10 years. In the initial first few years, you'd be 3.5%, or whenever you enter the market. In terms of apartments, it's the same thing. Melbourne's 2.5%, and then Sydney is actually going backwards. And if you look at different segments of Melbourne, you have the inner part of Melbourne where you have very high rents, $610. They've gone up by 1.7%. Interestingly enough, inner east and the south, 5.4, 8.3. So, inner south is the area where it's aggressively now rents are going up because people want to live there. Remember, people always want to live on the beach or in the mountains in Melbourne because you have the highest concentration of the best schools, and that's where all the money is. So people, if they can't afford to buy there, they'll rent. And this is why you have shortage of rental stock at the moment. And I'm talking about not apartments, townhouses and detached houses. So inner east, inner south have the best rental yields at the moment in Melbourne. That's why if you buy something there, you're going to get a very good rental yield compared to other areas like the northeast, the northwest, and even the outer east and the further suburbs like, Bayswater and those areas, you're getting very low rental yield increases. Where there you're getting very high increases in rental yields, which is quite good. So focus on at the moment, I'll show you which areas to focus on, but just be aware this happens. And for apartments, it's a similar story. What's really going to happen in the Melbourne property market in 2019? And this is, if you look at Moody's forecasting, look, this is what they think will happen 2018. You're going to have a bottom of the market and potentially 2019 and a slight recovery. I think it's pretty much on the ball. I see 2019 being very slow. I reckon we'll do something like 2% growth this year, maybe 1.5. If everything goes well. If Labor gets into power and introduces a reduction in negative gearing and also an increase in capital gain tax, we could even go to negative 5 or 6% in Melbourne. I think this year, 2019, will be flat, and I think it's a really good opportunity to buy properties if you know what you're looking for. And I think we're going to see recovery in 2020. Same with units, virtually the same, except the units are cheaper, so they'll recover a little bit quicker compared to houses and townhouses. Apartments are cheaper. And look, for a lot of people now, apartment housing is here to stay. If you want to live in Hawthorne, for most people, they're going to be living in an apartment, not a detached house. So it's either got $550,000 or $3 million, so who can afford $3 million for a property? So when you see the end is near and Armageddon's coming, just feel like Stephen Wright, who says, I'm having amnesia and deja vu at the same time. Be aware that the cyclical nature of the property market, because it is cyclical in nature. It's fairly predictable. You can't predict it 12 months ahead, but you can kind of know where we are, and we are 3 o'clock on the property clock in Melbourne. Now, how do I know that? Do I just make that stuff up? Do I wake up in the morning and say, you know what, I reckon about 3 o'clock. Yeah, it feels good. No, I don't. I don't make this stuff up. I actually do my research. And if you want to jump onto Herring Todd White Valuers, which is htw.com.au, you can download the housing report, and every month Herring Todd White Valuers, which is the biggest valuation company in Australia, creates the national property clock. And this is the national property clock from December 2018, and you can see that you got Melbourne declining market, 3 p.m. or 3 o'clock going down to 6. And there's some areas already at the peak of the market, and some are going into a strong, rising market to peak of the market. So there's all different property cycles. And this is the independent company. All they do is value properties. They don't sell anything. So you got to always be wary of people giving advice about what they're pushing or what they're selling. Valuers tend to be very independent, unbiased, because all they do is they report what's happening in the market and they value properties. To me, I look at it this way. Which areas in Melbourne have the highest risk of unemployment? It's the red areas. What are the red areas? They are the growth corridors, new house and land estates. If we are going to go into a recession and economic uncertainty, which it looks like we are, we've got the Liberal Party that has committed suicide, and they are rearranging chairs on the deck of the Titanic. And we've got a Prime Minister that no one voted for. Although I don't mind Scott Morrison, I actually like him. Then we have the Labor Party, and I just despise the Labor Party. I mean, the current leadership in the country is just pathetic compared to some of the leaders we had in the past. But they're kind of stuck with him. What can you do? I hope that Bill Shorten has a short career in the Labor Party and gets replaced. But it all depends on what's going to happen in the next election. Anyway, whatever happens, if the Liberals lose and the Labor Party comes into government, I think there could be, and they introduce all those policies, I think there could be a decline in the property market the next 12 months, 24 months, and I think there could even increase unemployment. And these are the areas that are going to be affected. So when you have the decline of the market, let's say it's the bottom of the market, 3 o'clock going to 6 o'clock, you got to kind of almost take a stand that's conservative to make sure that your assets don't be exposed to the wrong part of the market. And the wrong part of the market is basically the lower class blue collar areas of Melbourne. And we can see that already if you look at these areas. This is mortgage stress mapping from December 2018. The mortgage stress is defined as a household that's 3 months behind in their mortgage. That means they're about to lose their house. And these are the most exposed areas in ranking in Melbourne. Fountain Gate, Narre Warren South. So there's the postcode. Number of houses in stress, 5,076. Jesus. Berwick, Pakenham Upper, 4,923, 4,693. Craigieburn and surrounding areas, including Roxburgh Park. And then you have even the regional areas are getting affected as well, and predominantly because of the new estates that are being sold there. If you look at Ballarat North and those areas, a lot of these are newer estates that are more exposed. So young families buying brand new house and land packages rather than living in older established properties. Then you have Hillside, Sydenham, Hoppers Crossing, Tunny, Trigonina, and then you have your Cranbourne, or Cranbourne, as they call them in Melbourne. Cranbourne East, North, South, and West. Probably the highest risk area, in my opinion, apart from Melton, that you can invest in Melbourne. The amount of not only like for capital growth, it's a complete disaster. It's 2.8% growth per year. You have the highest bankruptcy and insolvency rates in Cranbourne and Cranbourne East, North, and South in Melbourne. So people are declaring bankrupt or insolvent. Insolvency is Part 9 of the Bankruptcy Act, and bankruptcy is Part 10. and they're losing their houses, and they're basically losing all their assets. So if you're an investor, you've got to be aware of these kind of risks, and these risks are really important to be aware of at the bottom of the cycle. And these areas are getting smashed. And also, you look at the manufacturing-based suburbs, blue-collar suburbs are really suffering as the car industry shuts down in Melbourne and exits Melbourne. You have car manufacturing shutting down and other businesses that rely on that. So you've got to be just aware of these factors when you're investing. Remember, population growth is what's really keeping the whole thing afloat. If you look at population growth to 2056, and this is for Victoria, we're going to have 8.4 million people, which is 3.3 million people moving to Victoria. 2.9 million people are going to be moving in Melbourne. We're going to have another 2.9 million people in Melbourne. And remember, these are not just migrants that are coming in with suitcases with clothing. These are people from China and Russia that are coming with millions of dollars in cash. So imagine what impact that's going to have on places like Glen Waverley or Box Hill or Bentley, areas that have really good schools, transport, access to amenities, infrastructure, etc. They're going to go through the roof. It's not slowing down. So just be aware as an investor, the market is cyclical in nature. It's always going to have ups and downs. That's not important because it's a paper loss. As long as you don't sell your property at the bottom and you don't get it revalued, nothing changes. All you do is keep buying and accumulating, living off the equity, capitalizing interest, or living off the rental. The cyclical nature of the property market will never change. You cannot have something that just keeps going up in value indefinitely. Those things don't exist. If they do, they're a Ponzi scheme or they are a bubble. Did you know there's only ever been 3 times in our history as a nation when Australian property prices suffered significant falls? The first one was the Great Depression from 1929 to 1939. This is where the national median price went down from, say, $3,400 for a house to $2,400. Lost $1,000, which is a third of the market. That's actually a big crash when you think about it. But what happens if you buy and hold and never sell? You wouldn't care. Then in the house prices during the credit squeeze, which is 1960 to 1967, property prices kind of went up and down, but more sideways movement than anything. But prices did plummet from 11 grand to 9,000, which is about 20% in terms of median price for detached housing. And then you have the GFC, which I told people was the best time to buy properties in 2008. Buy Middle Park, Port Melbourne, all those blue chip areas, but it's so expensive, Conrad. What if it crashes? Property prices, median price in Melbourne, 530,000, and now 850,000. But following these 3 declines, we've had, and this is 418 suburbs, we've had massive housing booms following every decline. So you've got to understand declines will pass and eventually the market will go into an upward trend. So during the downturn, not all the 418 suburbs in Melbourne devalued, depending on the demographics and household incomes associated with the area. Melbourne's fringe suburbs are much more susceptible to mortgage stress, price volatility, and vendor discounting than compared to the inner city blue chip affluent suburbs. These are the areas that get smashed in Melbourne during property declines, and they have massive amounts of properties on the market, and no one has the willingness to buy them. Hoppers Crossing, Tunny, Trigonina, Cranbourne, North, South, East, West, Sandhurst, Sky, Doreen, Mernda, Darrabit, Point Cook, Werribee, Pakenham South, Melton West, and then you just keep going through Roxborough Park, Craigieburn, Clyde, Epping. The volume of sales, couldn't help myself there. The volume of sales to top end has been drastically reduced as the rich choose when to sell, and hence the median price has fallen significantly in the sector. One of the things that people say is, well, Toorak has come off by 12 or 15%. No, the median price has come off because the rich just take the properties off the market. They don't need to sell. And this is what you're going to find is that the top end of the market is actually more resilient in price, not in median price fluctuation, but just in price than any other market, because they choose when to sell. There's no mortgage pressure there. Those houses are all paid off. They choose when to sell and when not to sell. The people that are most at risk are people that are leveraged 95% in a brand new home. And if something happens to their job or in the economy, or they can't get a job, or they're unskilled, that's who loses their house. And that's why these areas have the highest mortgage stress in Melbourne. So these are the areas that I encourage you as an investor to be aware of and avoid during the decline of the property cycle. So you got to look at things in two perspectives. You can either look at things as glass not full enough or half full. I look at things as from a positive perspective. That's what I look for. Well, I don't I respond. I don't react. 95% of people are reactive. That's why they end up dead broke at 65. One house paid off, 150,000 in the super fund, and they're going to live for another 25 years. What are they going to do? They're stuffed, and they can't borrow money when you're retired. If you're not working at 65, it's over. You know what I mean? You cannot borrow money. So you've only got your working years to make this happen and set yourself up for life. So you've got to learn how to respond, not react. Don't be reactive lemmings like 95% of society. Now, the fact that you're on this webinar already tells me you're not part of the 95% club. You are already in the 5% just because you're here rather than watching Married at First Sight, right? Because you guys invested in this time. You can watch it tomorrow on the app. The main thing is to keep the main thing the main thing. What's the main thing? The main thing is that the average homes in Australia may cost up to $6.3 million in just 25 years. This is from a study that has just been launched last year. Projections show median house prices will reach the figure in Sydney by 2043, up from $1,030,000 today. Aussie Home Loans and RP Data CoreLogic survey predicts the average house price will hit $5.8 million in Melbourne, $2.9 million in Canberra, $2.5 million in Perth, $2.3 million in Brisbane, and the biggest increase in Melbourne. Now, Melbourne's going to go up by $5.8 million. Imagine you absolutely knew this, that this is reality. This is your future crystal ball guaranteed. Could you sit back and do nothing? I mean, how many properties would you buy in Melbourne if you can pick them up for $1 million today and they're worth $5.8 million in 2043? How many will you buy? Because that's what's going to happen, guys. You got to understand. It might get within 10% of that. It might exceed that. If things keep going as they're going, which I think they will, and they're cyclical anyway, this is the future of Melbourne and Sydney house prices. People are going to be priced out of the market completely, like in Germany. 60 to 80% of people rent. Look at London. Everyone rents. No one can afford to buy properties there. The same thing's going to happen in Melbourne and Sydney. This is the last generation, guys, that we can still get into the market and buy some properties. And this is the definitive thing about this time in space where we are right now, is there's a turning point in Australia where the middle class is shrinking, and there's going to be a strong division between classes in Australia, between the rich and the poor. And I can tell you now, the dividing factor is going to be real estate holdings. That's going to be the key determining factor. Be fearful when others are greedy. Be greedy when others are fearful. Warren Buffett. So people are panicking now. This is the time to buy, get discounted properties, make offers, research key blue chip areas. Don't speculate. Don't take risks. Go out there and do your research. The top 1% of Australians own more wealth than the bottom 70% combined. Oxfam Australia has released a new report revealing wealth inequality is still on the rise in 2018 and getting worse. Why shouldn't it be? There's more and more idiots being born every year. Of course, it's going to get worse and worse. The 2018 report comes as new data shows that wealth divide in Sydney is becoming increasingly pronounced, with doctors and lawyers clustering in neighbourhoods close to central business districts. Where are they going to go? Western suburbs get stabbed, and the essential service workers as police, nurse, teachers being forced to settle in outer suburbs where property is more affordable, as reported by Fairfax Media. Of course, they're going to go where they can afford to. So the police officers and nurses and everyone else are going to live where the work is. But in Melbourne and Sydney, doctors and lawyers are clustering together in key suburbs. In Melbourne, it's Kew. $4 million. Safe, beautiful area, tree-lined, close to the city. The report, which relies on data from Credit Suisse, shows the level of wealth held by Australians, the richest 1% grew by 23% in 2017, up from 22% the year before, with the top 1% owning more wealth than the bottom 70% of Australians. That's because the 1% at the top invest in real estate, commercial, residential, stocks, bonds, annuities, and they leverage themselves. The other 70% watch Married at First Sight and they pay taxes, and they wonder why they're broke at 65. What happened? It shows wealth inequality in Australia has been on the rise over the past 2 decades. The gulf between the amount of wealth held by the top 1% and the bottom 50, now the greatest at any time over the period. And I'm telling you now, it's going to get worse and worse. Inequality in Australia is going to get worse, more profound, more pronounced between suburbs, and there's going to be a greater division gaps between suburbs that have suburbs and the have not suburbs. And as an individual, if you're in the middle class, you can still jump ship and you can still end up in the top 10 percentile. And it's going to be based on not how much money you save. You can't save yourself to wealth. It's how smart you're going to be with money and how you leverage yourself and then set up yourself for future generations. Which is exactly what I've been doing, was accumulating properties ever since we came to Australia in 85 and leaving those assets for my children and conditioning them never to sell anything, irrespective of what articles or the media will tell them. Keep accumulating and leave it for their kids and their future generations. And that's how you break the cycle. That's how wealthy people have become wealthy over the centuries. Nothing new, guys. It's all about land. It's about land in prime areas. It's never about the stock market or anything else. It's always been about land. The wealth share held by the top 1% in Australia has been growing almost continuously over the past 2 decades, while the wealth share held by the poorest 50% of Australians have been falling almost continuously over the past 2 decades. Now, people say, oh, you're almost like you're happy that the bottom 50% getting poorer. No, I'm saying if you want to do something about it, don't become one of them. If you want to change Australia, if you want to give back, become wealthy and give away your wealth, like Bill Gates. I mean, between Bill Gates and Warren Buffett, the two wealthiest billionaires in the world, they're giving away something like $100 billion. I mean, they've stopped diseases in Africa. So if you feel sorry for the poor, the best thing you can do is not become one of them. Become wealthy and then spend your whole life not at work, trapped in a cubicle answering emails for 80 hours, 60 to 80 hours a week, or 40 hours, whatever you work. Become wealthy and then give away your wealth and raise money for the poor. Create shelters. Do the thing that you want to do. So don't send me any emails about, oh, you're just a bastard making fun of the bottom 50%. Over the decades since the global financial crisis, the wealth of Australian billionaires has increased almost 140% to a total of $115.4 billion last year. Good on them. Yet over the same time, the average wage of ordinary Australians have increased just by 36%, and the average household grew by wealth by 12%. Well, they've got to get smarter and educated. The ignorance is not bliss, guys. Ignorance will send you to the poorhouse. You know, you think ignorance is bliss? Try. I mean, ignorance is going to send you to Centrelink. That's what you got to understand. Pensions should not be an option when you retire. You should be living off a passive income from your property portfolio. The richest 1% of Australians continue to own more wealth than the bottom 70% of Australians combined. While everyday Australians are struggling to get more and more to get by, the wealthiest groups have grown richer and richer. And I can tell you now, real estate ownership is the key determining factor here. And once again, these are the areas that I tell you. So I said at the beginning of the webinar, which are the areas to avoid, which areas to target. These are the areas that I recommend you not invest at the bottom of the property cycle, even if they recover. And there's always stories about, Broadmeadows, Hoppers Crossing, oh, it's going up now, maybe we should buy in. No, long-term it doesn't make sense. These are the best suburbs to invest in for 2019-20 because of the highest rent potential and obviously the blue chip areas anyway. So for the upmarket investor, depending on your serviceability, this is $1 million plus market. Albert Park, Port Melbourne, St Kilda, East, West, Balaclava, Brighton, Bentley East, Elwood, Hampton, Sandringham, Blackrock, Balmoral. That's for the Bayside. Entry-level Bayside and kind of southeast, Cheltenham, Hyde, Mentone, Morialek, Aspendale, especially Edith Vale and Morialek. They're doing really well. Aspendale's already expensive, but Morialek, Edith Vale, very good. Chelsea, Bond Beach, Chelsea Heights, Carrum. I don't like Seaford. People always don't send me emails. What about Seaford? It's just too far. Nothing happens in Seaford. Don't invest there. And Frankston, I've been hearing about Frankston for 20 years. How it's going to boom. It's never boomed. It's too far from Melbourne. Okay, it's not going to happen. Can you lose money in Frankston? No, you won't lose money in any suburb in Melbourne, but you need to make double-digit returns. Best area in Melbourne, Mont Albert and Mont Albert North. Kew, Canterbury, Camberwell. Any land holdings there, hold it for 10 years, you'll triple your money. Surrey Hills, Hawthorn, Bowen North, Glen Waverley, really good area. I'll be doing a lot of stuff in Glen Waverley. And also entry-level eastern suburbs, Box Hill. This is where I've been spending all my time sourcing properties. Box Hill North, Heidelberg Heights, Blackburn, Burwood East, Mitcham, Bayswater, Doncaster East. So these are the areas we're going to have high capital growth, high rental yields in the next 2 years. Anyway, I hope you enjoyed that webinar. Couple of things. If you want to get more education, I encourage you guys to attend my real estate investing fast track weekend, which I run from time to time. I'm running one this weekend. I think it's pretty much booked out. But just, if you're on our database, we're definitely going to give you some information about the next one. I do 10 of these P on average, and this is 2 days of education, 1 day on research and due diligence, and the second day we actually take you around to development sites and different suburbs and educate you live in the market, which is quite incredible. No one does kind of this level of education in Melbourne, so it's a great 2-day event. Very much all 90% education, and it's run here from our office in St Kilda. Also, if you want to get educated on finance, grab my book, bookonfinance.com.au, or go to amazon.com.au and pick up a copy of my book. Also, as a special bonus, just for being here on this webinar, I'm going to give you access to a brand new home study, which was, well, I shouldn't say brand new. It was actually recorded a few years ago now, probably about 4 now. Fundamentally, nothing's really changed from a macro level perspective. Micro level, yes, things have changed. That's why I'm doing an updated finance section to this home study. You can access this home study absolutely for free. It's valued at $497 just by going to the link that I was at the bottom of this video. It's very easy to navigate. You just point, click, and play. You get a manual that you can download. It's absolutely free, instant access, nothing to buy, nothing to pay for. So there's no upsell or any kind of hidden costs. It's yours for free, and that's the link there. You can go. That was recorded in 2016. It's 10 hours of video, and you get a 265-page manual digitally. Obviously, it's accessible digitally online, plus the manual is a PDF document. About to release an updated version of the finance section from Stephen McClutchy from Loans Australia, which is a 3-hour brand new section he recorded for my clients last year, which I'll make available on that particular portal as soon as we upload it there. So there's going to be a lot of new information there for you to view. Thank you very much from my end. It's been a pleasure spending this evening with you guys. I hope you picked up a few tricks and a couple of key distinctions about the market and where we are in the property cycle. Now, just to finish off, and I know that before I take questions in a second, I just want to finish off with one thing. Some of you have been emailing me for the last few months about my coaching program or the mentoring program that was already oversubscribed in 2017. Because of the lending changes and because of what's occurred, I'm actually reopening up 10 places in my mentoring program. The reason I'm doing that is because there's about 20 people in my mentoring program that are completely maxed out, which means they've got 3 or 4 properties. They probably won't be able to buy any property for the next 2 or 3 years because of the serviceability changes and the lending criteria changes that have been initiated by the banks as a result of the pressure from APRA, which means really I don't need to do any work with them. They're pretty much done. So I've got about 10 places that I thought I'll free up this year for my mentoring program, which I wasn't planning to do before. So my mentoring program, just to give you a 2-minute snapshot of what it is, it's an application, by application only. It's basically working with me one-on-one, and I'll help you build your entire property portfolio. Initially, we spend 3 hours doing a strategy session to work out where you want to be and where you are. And we do what's called the bridge gap analysis. And then you get my whole team of experts working with you, my financial planner, my lawyer, my accountant, all my people that I personally use to build my property portfolio. And then what we do is we max you out, and we you spend the whole day with me looking at real estate. I basically shortlist projects for you that are relevant to your price point and the amount of tax that you're paying, and I basically shortlist the best possible properties you can buy in Melbourne. I'm only exclusively targeting townhouses and detached houses in the best suburbs in Melbourne, the top 45 suburbs. You get a personal introduction, as I mentioned before, to my mortgage broker, accountant, property solicitor, or conveyancer, right down to quantity surveying, insurance, property management, financial planning, wills, estate planning, everything. And you get priority access to my developments that I source as well. So the whole network is built. Your whole team is basically built for you, which is like priceless. And we just basically build and fast track your results. Townhouses is the main vehicle that I focus on because you get advantage of buying into an established area, and where houses are unaffordable, but townhouses are the next best thing because effectively you're getting a house with no backyard. So the properties that I target in those areas, they range between 600,000 to probably around 2.2 million, depending on the area. Obviously, not everyone will qualify for this program. Not everyone can borrow 600 grand. But if you want to build a large property portfolio, and if you're not sure how to get started or what to do first or how to get structured correctly, this is the program for you. It's basically designed to fast track your ability to buy 10 properties over 10 years. And this is what I'm doing with all my clients. And some of them have already bought 6 properties in the last 3 years, which is incredible. The program is very structured. It's one-on-one with me. And it's basically based on results. It's not based on educating you so much as on implementation. So this is like getting a personal coach in the gym that stays with you every time you come in, and they basically coach you and take you through the workout set by set, until you get results by yourself. The program was originally launched in 2015, and as I said, I had 100 people in the program. Now I'm releasing 10 more places. It's $5,000 for 5 years. If you're interested in finding out more, just send me an email. I'll send you the application form, and I'll send you a link to a webinar you can watch, which talks about the program in extreme detail. It covers all your questions as well. That being said, I'd like to finish off now and take questions. So if you have any questions right now, feel free to type them in. For the rest of you, have a great night. Hope to see a future live event. And enjoy your evening. Thank you very much. Any questions, guys? This is the time to type them in. Give it a few minutes. Thank you, James. There's a lot of thank yous here. Thank you for tonight. Looking forward to seeing you this weekend. Thank you. Thanks, Heap, for the information. Conrad, thanks, Sophie. Pleasure. Hi, Conrad. Good evening. What is the cost of joining the mentoring program? It's $4,997 for 5 years, $5,000. Thank you for your webinar. What do you think about investing in Mount Waverley? It's very good, long term, absolutely great area. Where do you go to the western suburbs? Yeah, there's just not enough money there. Look, I don't mind Brunswick, Mini Pond, Essendon, those areas. There's pockets, Williamstown. The money in Melbourne is always going to be in the eastern suburbs and the Bayside. That's never going to change. And when it comes down to the lowest part of the cycle, where everything's slowing down, they're the most resilient markets because those people have more buffers in place. And the extreme of that spectrum is new estates, which are getting smashed at the moment. When the market's hot, everything goes up, and so you have to be a genius when we're 12 o'clock on the property clock. You've got to be a genius when we're 3 o'clock to 6 o'clock on the property clock. That separates people that make money and lose money. So you can make money anywhere, except not for Trigonina. What do you think of CoreLogic got the forecast wrong? Look, 9 out of 10 experts always get things wrong. They always overshoot or underperform. You kind of got to. I follow about 12 experts, and then I look at all the information. I put it all together in my head, and then I listen to my gut instincts, and I still get it 70% right. But the thing is, I don't need to be accurate to make money, because even if I'm wrong by 30 or 40% of the time, I still win majority of the time, and I have buffers in place. And property is a very forgiving asset class because you buy and hold long term. So you have to be really silly to lose money in property. You have to have really unfortunate circumstances where you're forced to sell at the bottom of the market, which is unfortunate when that happens. What are your thoughts on Sunshine? I'm a big fan of Sunshine. I sourced townhouses there. I think it's done really well. Hey, Sunshine's expensive now. Two bedders are 600,000, three bedders are 750. So Sunshine around Sunshine Plaza, very good investment. You got very good money going into the area, no problem. Cheers, Robin Marlene. Thank you. Albion, no, I wouldn't touch Albion unless you're doing subdivisions. Albion's got no money in it. It's all blue collar. Roville, too far. No, there's nothing happening in Roville, and you can't get to Roville during peak hour traffic. People leave Roville after they buy there. Nothing wrong living there. And by the way, don't ever mistake livability of an area versus investment. Okay, because Roville's a good family area, but it's not necessarily the best capital growth area. So you just got to ask yourself, well, if you've only got so much money you can borrow, where would you hold it to get the highest possible return? And Roville's not the place. If you want to, there's a question here about what projects do you have in Glen Waverley. I've got many projects. I've got hundreds of developers that I have access to in Melbourne. So if you want to email me directly with your price points, I can send you some information on what I have. When's your next 2-day? You will lock it in on Monday, so I don't know at the moment. I've forgotten actually. I said it last year before I went on holidays, and I can't think at the moment. So yeah, no. So if you just stay tuned on Monday after this event, the website will be updated with the latest dates. What do you think of Nunawading suburb? Yeah, it's good. I mean, Mitcham's got much more money than Nunawading, and it's got better properties, especially between Maroondah Highway and Canterbury Road. That's the pocket that I'll be targeting. Mitcham's very different than Nunawading. They're good areas. I mean, all those areas are very green, leafy. Blackburn, and then if you go down to Vermont South, Bayswater, all those areas are fine. You just got to pick your pocket. I think Mitcham and Blackburn will always do better than the rest. Although Vermont South are always doing well. They're very tightly held areas. They've got Vermont Secondary College there and a couple of other schools in the area that are really good. So you just got to pick the right property. I would be buying big blocks of land there for subdivision. I wouldn't necessarily be targeting townhouses. It's a bit far from the city. You're looking at 28 k's from the city here, so you just got to be careful. I'm 25 years single guy who just started working. My salary is around 63,000 before tax. When will I able to afford a place? In about 20 years. Depending on your saving ability, that's the reality. And by the way, I'm not making fun of you. It's just it's an expensive market, You're better off buying Bendigo and Ballarat for 300 grand, getting in the market there, leveraging your money, and even buying a few properties there, putting them on Airbnb to get your cash flow up, and then going to Melbourne. You might not be able to buy Melbourne initially, like we did when we were kids going in our first job. Thank you, Conrad. When will property prices likely to increase? In 2020. Any thoughts on building your own first home as a PPR, own a builder? Yeah, definitely. Just don't build in a new estate. New estates do not work in Melbourne. There's 96 new estates, and they always underperform. And the worst ones are Melton, Trigonina, Tarneet, those areas, because they have the lowest income demographics in Melbourne. So if you're going to build, buy something established, go into an established area and build there, or even buy a big block, chop it in half, sell the backyard, or build two, sell one, pay off the other one, whatever. Maybe he's going to be able to contribute sweet equity content. What do you think of Croydon? Croydon was good 3 years ago for subdivisions. Now I think it's actually too expensive now. But Croydon Hills, one of the last pockets in Melbourne, you can still buy very cheap subdivisions. How much mortgage stress calculated? It's based on, from Ryan, it's based on couples or households that are more than 90 days behind their mortgage. So the mortgages have gone back, so they haven't paid the mortgage for 3 months, and they're getting those letters, not even legal letters now, they're getting letters like, we're going to repossess your house, we're going to kick you out, and then they go back and negotiate some kind of a payment scheme. So they're stressed, truly stressed around their mortgages, right? Not a good thing, especially got 5,000 homes in the area and they're all stressed. Tells you something about the area. Chirac, zero mortgage stress. They got champagne and caviar every time they, right, all day long. What's the? No, they don't. I don't know what they do. What is the best way to perform market research and due diligence using RP data as the main source of information? A good start. Where from here? Yeah, well, RP data is definitely the best, but you got to be an agent in Melbourne to become an RP data user. It's not easy to use. So, but that's definitely RP data. CoreLogic is one of the tools that I recommend that you use. What about all the units in areas like Elwood, St Kilda? Very good, especially Art Deco units. But I would do renovations, depending on your strategy, you know. Yeah, Elwood, St Kilda, very good areas for Art Deco units and apartments. Mine's townhouses because I want 3-bedroom double lock-up garage, but I don't want to pay $2 million. So the only option is to pay 800 to 900 to $1 million in a good area like Bentley. No one's got money for an older house, and you can't get depreciation. Usually they have 3 bedrooms, 1 bathroom, so you can't get the rental. So townhouse is the best vehicle to build wealth in Melbourne. You get a brand new property, 3-bedroom, 3-bathroom, for example, like Ryan on our webinar purchased just recently. You get a good rental, 3 bedders, you know, double lock-up garage, brand new, there's no structural problems, and you get a really good tenant. It's not about the property, guys. 80% of the value is the area, 20% is the property. 80% of the value is the area, 20% is the dwelling. 1-bedroom townhouse in Richmond will always outperform a 5-bedroom house in Dandenong, always, because Richmond land is more expensive than land in Dandenong, irrespective of the size. 150 square meters of Richmond will outperform 1,000 square meters in Dandenong. So it's about location scarcity and the right demographics and having the demand for the right demographics. Glenmabry has declined 10%. Do you think it will drop further? Which one is lower risk between McKinnon School Zone or Brighton East development? Yeah, I mean, Glenmabry has declined because people have taken properties off the market. They're not selling. The median price has gone backwards. And vendors are always unrealistic in Glenmabry what they can get for the house. Will it drop further? Yes, I think Glenmabry will drop further. And I think it will probably go by -6% this year and maybe another -6-10% next year. Which is the lower risk between the two? McKinnon School Zone or Brighton East for side-by-side development? Well, Brighton East is better than McKinnon, so McKinnon's, yeah, I think that's the question you're asking me. Is McKinnon better than Brighton East? No, Brighton East is better than McKinnon. Thanks for the webinar. What do you think about regional Victoria? Yes, Ballarat, Bendigo. Bendigo is the #1 best regional area you can invest in Australia, full stop. I like to have, if it's possible to enter those. Hi, Conrad. Thanks for the info. I'd like to ask if it's possible to enter those blue chip. I don't know. I'm not sure what that question is. Thank you. Great webinar. Thank you very much. Is Airbnb a better choice for Elwood? I have a small townhouse. Yes. Airbnb for Elwood, St Kilda, as long as it's the right property, is your best option. The banks are coming around to it now, so they're giving you really good serviceability, and you're getting much more cash flow than getting rental from a tenant. Some areas Airbnb doesn't work. Like if you have to go to Mitcham and get Airbnb, you'll be vacant most of the time. But in Elwood, St Kilda, you know, Ripponlea, probably Port Melbourne, Albert Park, those iconic suburbs are in Melbourne. Williamstown, North Melbourne, East Melbourne, South Melbourne, you know, Brunswick. Airbnb is not an issue, you know. So you just got to factor that in, factor in the insurance and cleaning, and go for it. Okay, I think that's it for the question. So thank you very much, guys. You've been a great audience. I hope to meet you personally one day in one of my live events. Have a good night, and we'll chat soon and enjoy Married at First Sight. Thank you.